Hello traders, Jeff with optionboxer.com, back with another strategy video for you today. Something I think you're really going to like. I know it's something that I'm going to be implementing into my own trading very soon. But please know that this is not a recommendation for you to buy or sell any security or attempt any option strategy. I'm not a registered financial advisor. I'm just a trader like any one of you. First you're going to look at the chart, which is what we always do. We take a look at the chart and we say, okay, what do we think? In this instance, I'm looking at SPY. This works for any other market or any other asset. And let's say, so I'm bearish on the market. I've looked at all my indicators, I've done my research, and now I think this stock is going to trade down. So what I'm going to try to do, if you've watched any of my other videos, I'm always looking for 50-50 pot odds. So that's the first thing. And 55 cents per contract here, or per spread, certainly gives me 50-50 pot odds on a dollar wide strike. And so I'm going to go ahead and set that up to analyze that. And then what I'm going to do, so I got the 324, 325. I'm simply going to now buy a vertical spread, which is in direct contradiction to the short spread. Obviously a short spread, we're bearish on the market, and then a long vertical call spread would be bullish on the market. And I'll show you why I'm going to do that here in just a second. So I've got the 324, 325 short spread, and I'm just going to bounce down here to about 328 by a vertical spread. And so what I would caution you against is going and just buying the cheapest vertical spread you can. And the reason I'm saying that is because, yeah, you can get a cheaper price here on the vertical if you come way down here. So let's go ahead and show all of them. So you can come way down here and you can buy a super cheap vertical spread, but the risk reward is going to look really nice. But let's be honest. I mean, that's a huge run in only 59 days. And so if you look at this risk reward diagram here, you can see we've got a $16 maximum profit and a $84 maximum loss as it stands right now. Well, we did a lot of research, and we really believe in this trade. Well, $16 just may not be enough. You're tying up $100 there on buying power and $100 there in buying power. So you've got $200 tied up to make $16 if things go well. So if you wanted to keep this trade open, you could certainly do that. You only have a 21% chance. Oh, it's actually better than that. So I need to back this up. So there's actually only an 11% chance that it finishes inside this range here, which means, strictly from the mathematical probabilities perspective, I mean, this is a very high probability trade. You've got a 60% chance there pretty much, and almost a 30% chance there that it finishes on one side or the other. But you're probably thinking, well, $16 and you're risking $84, the risk reward just doesn't seem very lucrative there. So let's try to change that a little bit. And the way we're going to change that is we're going to have to kind of reconstruct this graph, and we're going to do that by changing our strikes and the ratio to short strikes to long strikes. So we're going to go ahead and make it two short verticals to long verticals. So we're going to go ahead and make it two short vertical calls, and you can see that bumps up our profit considerably from the 16 that it was up to 71, which I think is a little more reasonable. And we're going to widen out this particular long vertical spread so that we can make money. So you can see here, if I left it at 329, if it finishes on this side of the kind of this valley, if it finishes over here, we're still going to lose money, $29 to be exact. I mean, that's certainly better than if we had just opened this vertical spread alone. So, it's certainly mitigating our risk. In fact, it's taking the $90 it's taking the $90 that we would have been risking on these two short verticals and turning it into only a $30 or a $29 maximum loss. And that may be good enough. But for me, I'd like to see the payoff be a little bit better on both sides. And so you can see we had to give up some of those substantial gains over here, but we also opened the door for us to make money on the back end. So really what I'm saying to you is you don't have to be right on whether it goes higher or lower. It just has to go higher or lower. And so this diagram looks really, I don't know, it looks really scary. You're saying, okay, we're only going to make $36 on the, above our strikes, or we're only going to make $36 below them. But what about this huge valley here that says we're going to lose 164? So the first thing I'm going to point out as we talk about this valley is, again, you have a 13% probability that it'll finish inside this range. So let's just call it 10% just for the sake of easy discussion. You've got a 90% probability that it's going to finish outside of this range, a 10% probability that it's going to finish outside of this range. Well, let's say that another way. 9 out of 10 times you're going to make $36. Or let's call it 40 for easy math. So 40 times 9, that's $360. And then 1 out of 10 times, you're going to lose 164. Well, do the math. 300 and let's see, what was it? 90 times 40 or 9 times 4 is 360. Is my math right? I got to always check myself. 9 times 40, 360. And then the one time, and here's the thing. So the one time, if you lost the maximum, would be 164. So 360 minus 164 still nets you $196 on this strategy out of the next 10 trades. But here's what I really want you to see. So it looks very scary with this 164, but let's go all the way to the week before expiration. So this expires on February the 20th. So let's go exactly 1 week from expiration. Well, that doesn't really seem too scary. If you look at this pink number here, let's say price was directly in line with the middle of this valley here. The most we would lose at that point is $36. Well, I've taken hundreds of $36 losses in my trading career. $36 isn't really scary at all. So let's just keep going forward. You can see that pink line as you get closer to expiration. This is the day before expiration, by the way. Let's say you held it all the way to the day before expiration. You're still only looking at an $84 maximum loss. Well, $36 maximum gain, $86 maximum loss, that's not a terrible risk reward. It's almost 50-50. And if you go just 2 days before expiration, you're better than 50-50. And so that's why I think the strategy is a little bit unique. There may be others out there that are trading it, but it's certainly something I'm going to be taking a look at. And I hope that I didn't get too long-winded on my explanation or too excited about the prospects of this particular strategy. All right, if you have any questions, feel free to reach me at optionboxer.com. Thanks for watching.